Valuing banks can be daunting due to two main challenges: estimating cash flows and dealing with regulatory frameworks. These firms often operate under stringent capital regulations like you see above, and the Basel Accords that significantly impact how these firms are valued. Unlike non-financial firms, banks are best valued using equity models instead of enterprise models. Estimating debt and reinvestment for banks is difficult because debt isn't capital for them, it's raw material. This makes traditional calculations less useful. As a result, we often rely on the dividend discount model, which values a bank based on the present value of expected dividends. To calculate the cost of equity, use average or median sector betas for discount rates of similar banks, adjusting for business risks like getting into securitization, investment banking, or high-growth phases. You don't need to unlever or relever betas, as debt calculation in banks is complex. Use your country's risk-free rate as the growth rate and the industry median price-to-book and return on equity values of similar banks in the formula I've shared here. Also, feel free to adjust the cost of equity based on the bank's regulatory capital using sector benchmarks like earlier, and remember, higher capital lowers risk. After calculating the cost of equity, the next step is to create a forecast model. During the operating phase, which we can assume lasts 5 to 10 years, we can calculate the growth rate using the formula, return on equity multiplied by 1 minus the dividend payout ratio. And finally, in the terminal phase, it's advisable to estimate growth in line with the risk-free rate. But if a bank does not pay dividends or pays very little, an issue that has become more common since the 2008 financial crisis, we can estimate free cash flows or potential dividends by adjusting net income with changes in regulatory capital. For instance, if we anticipate our bank will grow at 5% and that its loan portfolio will grow at the same rate, we should also expect Tier 1 capital requirements to increase. This increase will result in a decrease in available cash flows. Using the free cash flow approach can lead to a more accurate valuation of your bank, as dividends can be unpredictable. Discounting free cash flows is also a more intuitive method for readers to understand. Thank you for watching. Be sure to follow for more insights like these.